What's going on, guys? It's Jordan de Jong here, and today I want to talk about if the property market could actually see a significant crash. Specifically, I'll be talking about Sydney and Melbourne, as these are the two most dominant markets. And even still, there are submarkets within these cities that will be more impacted than others. All markets go through their cycles. There's no doubt right now that the property market has slowed down. Unfortunately, due to the lag of data, it's hard to really determine the current state of where we're at. What we do know though is that there's plenty of uncertainty out there and the market has almost ceased transacting. What we have seen in recent data is auction clearance rates dropping to 37% due to those ban on auctions. For context, in the last market slowdown between 2017 and 2019, we saw auction clearance rates bottom out at around 40%. And not only 2 weeks ago, we were seeing clearance rates of 70+%. So auctions have definitely come to a halt. Although, just a side note, we can't compare apples to apples in any market. We just know that they move in cycles. If you're trying to relate the current market downturn to 2017 to 2019 market downturn, that was a man-made market adjustment, mostly driven by APRA playing with the lending levers. What we're seeing now is a pandemic causing an economy to come to a stop. Mixed in with this clearance rate, and probably why we're getting the results that we are, is auction withdrawals, meaning if property is withdrawn from auction, it's considered a non-sale result. And with all of this uncertainty, we've been seeing 50.2% of auctions being withdrawn before they go on auction day. On a positive note, what we have seen is 66.7% of auctions being sold prior to auction. So a lot more pre-auction and private sales are being transacted. Historically, auction clearance rates have been a great indicator of the direction of the market. And Louis Christopher of SQM Research has been quoted to say that he can start to see a market turning point just based on the auction clearance rates. So going forward in the current market, not being able to see a clean and accurate clearance rate makes it even harder to see what's happening out there. Speaking of Louis, he has just released a research document on why a 30% decline is a real possibility, which has triggered me to make this video. And if you're loving this content, make sure you smash that like button. Louis has clearly stated that he has not modeled this 30% peak to trough decline. And it's pretty obvious that trying to model anything in this current environment is pretty impossible, especially considering big indicators such as that auction clearance rate aren't being reported under their usual conditions. What Louis did say about this 30% decline is the most overvalued cities would be hit the hardest, that being Sydney and Melbourne. Other cities could do better than a 30% correction given their relative fair value. He also said, now some of you will know that during the Great Depression, the Australian housing market did not correct by this magnitude, nor during the Spanish plague of 1919 did the Australian housing market record such a correction. However, those two markets were not laden by the debt burden our current housing market has, not even close. It's still very early days to see any of this play out, but what we have been seeing in recent value data is a rolling 28-day change in the daily home value index from Corelogic. Nothing dramatic here, but it's a good indication that a drop has come through, and it is pretty expected. Because property as an asset class is very illiquid, meaning we can't just go out tomorrow and sell our property without significant costs, we don't see prices fall dramatically overnight like we do the stock markets. However, a snowball effect can take place over time. Say everyone's listing their property for sale and listing numbers starting to add up. We could see a lot of stock on the market at a discounted value. By over time, I mean, say someone who's just lost their job is now in financial stress to repay their mortgage. They might have some cash savings that they can eat into, but eventually they would all get eaten up, and after a couple of months they really need that money just to put food on the table. Obviously banks are helping people in this scenario, but we'll get into that a little later in this video. Before we get into it, I also want to talk about the rental market. Usually the rental market and the property market aren't specifically correlated. In fact, if you think about it, if rent's starting to increase while mortgages were decreasing, then the thought of buying property instead of renting a property for the same running costs may be more enticing. What we are seeing pretty dramatically change is that rental market. With our borders now shut and many international residents returning home, they're no longer renting housing in Australia. Obviously, if they were contracted to do so, they still are. However, if they were rolling on a month-to-month basis or something like that, they would have just packed up and gone home. On top of this, there's no tourism or people visiting Sydney and Melbourne for a holiday, wedding, or to visit family. So the recent boom in short-term accommodation, such as Airbnb, has been whiplashed back to long-term accommodation. Together, this has resulted in a surcharge of rental listings coming onto the market. We can see this through sites such as Domain by tracking how many rental listings are coming onto the website daily. This is a pure supply and demand market right now, with skyrocketing supply and a demand shortage. due to those residents returning to their home countries and Aussies even losing their jobs, meaning they might be going to live back home or on a friend's couch. In my opinion, this will most likely lead to rental listing prices being reduced and will have an impact on rental yields for investors. So what does this mean for the property market? With less rental yield subject to property prices staying where they are now, and uncertainty if they're even going to get a tenant, and if they do get a tenant, will the tenant pay their rent, this could lead to less demand in the market from investors. Although I would never recommend an investor sell an investment property unless they absolutely had to, there are still some investors that will irrationally react to this market, and others who are in real financial difficulties forcing them to sell their property at a discount. There is plenty of stimulus for investors in this position right now, and banks are giving a 6-month mortgage repayment holiday to those in financial stress. So there are options for investors in this position to hold on to their assets for the short term. As for owner-occupiers, money is cheap right now. In fact, it's the cheapest it's ever been. We're seeing fixed loans being locked in at a rate of 2.05%, and the RBA has stated that they won't be rising the cash rate anytime soon, specifically when unemployment gets back down to 4%. Given the incentives that are already in the market for first home buyers, this could be a golden opportunity for renters who are in the right financial position and have strong job security to buy a place of residence. Additionally, if the rental market conditions are being relaxed, tenants may have more flexibility in their rental terms, such as going on a month-to-month basis or having reduced rent payments, and this would allow them some breathing time to save as much as possible and potentially get into the market over the next 6 to 12 months. So although there may be a slowdown from investors, there may be an increased demand from first home buyers. And once there's more certainty about the market, this could flow through all the way up the chain. Upgraders can now move into bigger homes and downsizers can move into their more desired locations. I guess uncertainty and time are the biggest two factors here. We don't know how long this pandemic is going to pan out for. There is no clear end date right now. We don't have an approved vaccine and we don't have enough information about the virus to have a clear picture of how the next 6 to 18 months will look. Again, how long after we lift the lockdown restrictions will we open the international borders again? A big proportion of population growth in Australia is through migration, and without people coming into Australia, we'll have less demand for the market overall, in both rentals and owner-occupiers looking to buy. The government and the RBA keep talking about building this bridge, which was originally coined by Christopher Joy. But how big can they build this bridge? If we're shut down for 12 to 18 months, will they continue to pump stimulus into the economy? Will they allow interest repayments to go unpaid for 18 months? Who knows? If this really is a long haul, then we could be in for some serious trouble. Without continual stimulus from the government, we will surely head into a depression, and the impact of the property market will be unprecedented. A 30% decline cannot be ruled out, although it would take the very worst case scenario for this to happen, and to be frank, we would have much more to worry about than the property market in that scenario. On the other side, if we continue to print money out of thin air, literally pools of money are being printed right now, then when the economy returns back to normal, these pools will all get soaked up, and all the money that was originally in the economy, plus everything that's being printed now, will combine together and the prices of all goods and services will increase. This will, in relative terms, increase the prices of property too. If there is enough inflation to see it reflected dramatically on property, it could lead to a sharp upturn in property prices. But this is very different than a demand-driven price increase. A demand-driven price increase mostly comes from owner-occupier appeal. Essentially, homes in areas where people actually want to live. And this is why markets like Sydney and Melbourne have increased to the levels that we have seen recently. Their prices are significantly higher than the rest of the country, because there's a larger population of people that provide demand for those markets. Which, over 30 years of positive economic growth, we've inflated those prices to a point where it requires two strong incomes in the family to service a loan of that size. I think we can get through a 6-month period. Not unscathed, but as a country, I think we'll hold pretty steady. 12 months will be much harder and require continuous stimulus. Those existing investors that are still in financial hardship will require additional compensation. And if they don't get it, we may see more listings come onto the market. Anything longer than 12 months will be detrimental to the economy, and we could take some time to get back to having double income families servicing those large debts that we're seeing today. This would lead to less demand from both investors and owner-occupiers for property that's priced at the current levels. And specifically in those larger markets, we could see prices being significantly reduced. I want to know what you guys think will happen to the property market. Leave it down in the comment section below. As always, seek your own professional financial, legal, taxation, and property investing advice for your current situation. These videos are just my opinion and are general in nature and should never be considered as personal advice. If you're keen for more content, make sure you subscribe and smash that notification bell so you don't miss a video. And until next time, happy house hunting.